Hello and welcome to the Professional Amateur, episode 3, I believe. This one's going to be really quick today. I just wanted to point out something that I think is pertinent about the decoupling of a major trend in economics. So I'll have all of these links in the show notes. Let me put this over here. So this happens to be a chart of total assets of the Federal Reserve, the European Central Bank, and the Bank of Japan here, on the blue line. And the red is the S&P 500 stock index. And this is marked from the great financial crisis of 2008 all the way up through to December 10th of 2019. So we're going into 2020 as of here. So obviously you don't have to be, like it says here in the article, one doesn't need to be a chartist or a statistician in order to easily see how high the correlation between the two is. Now, correlation is not causation, so I'm not trying to say that the Fed balance sheet or the central bank balance sheet is 100% the cause, right? But it's highly correlated. Stocks go up when central banks buy more assets, and that includes treasuries, mortgage-backed securities, and now stocks. So in case you didn't know, both the Bank of Japan and the ECB have been pretty active, as well as the Swiss National Bank, which isn't included on here, in buying stocks. So I think the Bank of Japan is getting close to owning 50% of all the bond issuance of Japan, as well as buying up massive amounts of stocks. So I think the correlation here is that you see, as we had the great financial crisis and the S&P crashed down to lows in 2009, the banks responded by massively pumping money into their balance sheets and buying up bonds and other assets, bad mortgages, all kinds of things. And they've persisted in doing this through the quantitative easing programs. And then here we had a taper, and as soon as they started tapering, we see that the stock market started pulling back. And then they started job owning about, more stimulus to drive it back up. And then we had basically the peak of the stock market here in like December-ish I think it was really January. So we had stock market all-time highs. Of course, now, if we look today, over the last year, the S&P 500 is actually crashing way down. And it's down again today. We had like a dead cat bounce here is what they call it, and then it's back down. That's probably over my picture, so let me put this out. But in any case, I'm going to make the suggestion that stock prices have completely decoupled from the central bank balance sheets. So because what we have going on today, if I go over here and look at the Federal Reserve's balance sheet, is ever since last week, the coronavirus stuff came out. Powell, they did an emergency rate cut, and the balance sheet jumped from 4.1 trillion up to 4.24 trillion. That's a pretty big jump. And if we go back 10 years on this chart, you can see that, let me actually go out max. 2008, the financial crisis caused a massive jump in the balance sheet. They jumped up and started buying up all kinds of things. And you can see, to maintain that, basically both the real estate and the stock market bubble were maintained by central bank policy as they just continued purchasing assets. And they tried to taper, market started cratering, and we had the repo crisis over here in September of 2019. So if I zoom in on that, you can see they've started to taper, and then boom, repo crisis. And if we look at the last year, ever since the repo crisis, they've been adding to the balance sheet, tried to taper again for a small period of time, and then the coronavirus hit, and boom, we're back off to the races. So what's different this time? The correlation seems to be over, and that's distressing because it means the Fed may have lost control of being able to inflate asset prices. So quantitative easing went up, and for the first time, the stock market in response went down, not up. So this is just the last couple days in the market. Let me go. Actually, this is 5 days. Go out to a month here. So at this point, somewhere in here, they cut rates between what, the 3rd and the 4th of March. They had an emergency rate cut, and then things have continued going down. So not only did they do a rate cut, which should increase liquidity, should increase money in the system, which would, you would think that would help boost things. It didn't have that effect. It had the opposite effect, which means I think this is diminishing returns, basically. So if I could extend this chart out today, you would see that this is going up while the stock market's going down. The correlation has broken. Why is this a problem? Because, so here's another chart of all the central banks' asset holdings. So we've got the European Central Bank, the Bank of England, the Bank of Japan. And these are all international ones. And you can see here the BOJ line, the Bank of Japan, has been buying up treasuries, outright stock purchases for quite some time now, since the Great Financial Crisis. They've been buying up, and they, as a percentage of GDP, have been buying up much more than the other banks. Well, we're all headed that way. So I think Japan is the canary in the coal mine. But we're reaching diminishing returns, which means, for every dollar injected into the system of funny money, you only get so much growth out of it. Well, I think we've reached the peak of that growth, so now we're going to see the opposite happen, to where each added dollar actually causes a loss in the system. So this is something to prepare for going forward. I think the central banks have basically made it clear that what they're going to do is continue to add liquidity, to buy up. I mean, they've even talked about buying up stocks in the United States. I know the Swiss National Bank buys up a lot of American equities. So it seems like it's decoupled, and that's a problem. So in my last video, I said, they're going to keep printing, they're going to keep trying to buoy the stock market, and maybe they win, maybe it works. And it seems to me like it's decoupled and it's not working. So basically what I'm saying is, I think we're going to see more extreme monetary policy coming out of the central banks in the days ahead. Probably more extreme asset purchases, banking crises happening very soon, and stock market, who knows? Will they be able to save it? I think it's bad policy. I think that the inflation of asset bubbles is not actually leading to prosperity for most Americans. It's actually increasing the wealth gap. It's increasing poverty. It's also increasing riches for a few people, but it's increasing poverty for the majority. And I think that this needs to pop. I think the bubble needs to pop, and we need to come back to reality, but it's going to be pretty painful for a lot of people, and that's really sucks. But it's inevitable. It's going to happen. Whether they stave it off for another short while with extreme monetary policy measures, it's going to be inflationary, and it's going to come out sideways somewhere, because we're in uncharted territory. And if, going back to the chart here, the central bank did not used to, prior to the Great Financial Crisis, buy up tons of treasuries and stocks and bonds and mortgage-backed securities. They didn't do that because the market was allowed to clear. And since the Great Financial Crisis, and basically our government, the United States government and the central banks have decided that the stock market is the economy somehow, and that asset prices and home prices are the economy, which I think is a grave error, a grave mistake. And we've been doing, 10 plus years of basically massive asset purchases, and it's not going to work. We're reaching diminishing returns. So I'll go ahead and post these all in the show notes, and leave all the links for all of these things on there for you. But in any case, I just thought it was interesting to note that basically stocks seem to have decoupled from this trajectory. So instead of going up as the balance sheets go up, the balance sheets have gone up just in the last week, and instead the stock market's gone down. So will this trend continue? If so, it's a problem for the stock market, obviously. I don't personally own any stocks, so I don't care. I'm all for letting it crash and let the market clear. I think we need free markets again. We haven't had free markets for a long, long time. And, capitalism is not the problem. Central bank intervention in the market is causing the wealth gap. Structurally, there's problems, but when we don't let the market clear and we don't let banks go bankrupt, we have the problems that we have today in society. So anyway, that's all for today. Thanks for listening, and I'll catch you next time.